Okay. So it is 11, and we're still letting a few people in, so I'll give it about 2 more minutes. You can grab your coffee, whatever you need, before we get started. But yeah, really looking forward for a great session. And oh, Dustin is right here. Hi, Dustin.
Hello.
There are two Dustins in the room, so
A rare instance of two Dustins. Hello, other Dustin.
we're just letting a few more people into the session, so just hold on tight. We're just letting a few more people in. I apologize for the delay, but just to get us started, so in the chat, if you can just drop your name, company, where you're calling from, and 3 words, and what you're looking forward to hearing about this session. So I'll get us started. My name's Noreene Bautista. I'm with the Pittsburgh Technology Council and 40 by 80. I'm calling in from Pittsburgh, and I'm really excited to hear about Brian Scott's Pitmos. So super excited for that. I'll put it in the chat again, what typing in. So can I get 5 volunteers to introduce themselves off mute?
Hi.
Hey, Charles.
Hi, I'm Charles. I'm Startup Ecosystem Manager at Innovate PGH, a nonprofit trying to make it easier for startups to build and scale in Pittsburgh. And I'm calling in from Oakland.
Nice.
Hi, I'm Justin Blanding. I was part of an e-commerce unicorn and rode the train from 0 to 1.6 billion to 0. And in the past 2 years, I've been instead moving towards generative AI and consulting, and I'm currently working on a startup here in Pittsburgh.
Hey all, Lou Simon. I lead innovation for a consultancy. I do a lot of our AI, and we have a specialized product to help us in that. So we're looking for VC funding there. I also have my own startup that I'm working on here in the city of Pittsburgh with a couple people. I see a few folks that I know on the call, but I'm really looking to get a little bit more out of the process. We've had in both kind of venues trying to do this intrapreneurial and entrepreneurial thing, meeting the right leaders in the VC space and in the capital raising space to make it easy for us to gain capital. It's been very hard to even network. So I would really love like ways that you guys would recommend approaching.
Thanks, Lou.
I'm Julie Golick. I'm here in Pittsburgh in the Strip District. Work with Ballet Design, but I've worked in accelerators before in Boston. I hear everybody complain that there's not enough money, VC money coming into Pittsburgh. I do a tremendous amount of pitch coaching, and I'm looking for input on what VCs are looking for so that I can help prepare startups even better for what their needs are, what they're looking for. I have a lot of experience in the Boston ecosystem. I know what they were looking for about 5 years ago, and I want to see if that's changed or what these needs are that we're not fulfilling, because we need to fulfill them and get more money in this city to fuel this innovation ecosystem.
There's a lot of really gritty, smart people here. It's just very difficult to get that out more broadly as a brand.
Thanks, Julie.
Yeah.
And we have one more person who can speak. Paula, I'm looking at you. Hi, Paula, how are you?
Hi, how are you? I am Paula. I'm currently working on an ad tech startup, currently working also right now in engineering in the office for a BFA partner company in the tax preparation software space. So we've been able to get a lot of funding recently. So it's been really exciting. I did like a 5-week ideation program and then just kind of like looking to get that ball rolling, especially in how to like create connections and speak to the right people.
Thank you. I see very familiar faces, so thank you all for joining. If some of you all, if you can please turn on your cameras, we wanted to really foster a really welcoming and engaging environment. So before we get started, I wanted to give a quick shout out to the VFA community who are here to support. As a reminder, if you're interested in leading or collaborating a Skillshare similar to this, please drop me a message. Second of all, Maria Fator is here with me today, and she will be helping moderate some questions. And then lastly, a couple of housekeeping. If you have a question for the speaker, please type it in the chat and we will address it after their presentation. And if you're a founder in the call who's in their fundraising round, you can drop your pitch deck in this Google Drive that I will share in the chat. And we will share this with investors and panelists after the session. So this is the Google Drive. All right, so let's get started. So for our first speaker, we have Dustin Betts from White Rose Ventures. Dustin, do you want to just give us a brief background of your work?
Absolutely. Yeah. Thanks, Julie, for having me. Dustin Betts, White Rose Ventures. We are headquartered in York in South Central Pennsylvania, and our firm's investment thesis is focused specifically on backing Pennsylvania-based companies. So and I should say at the earliest stages, so at the pre-seed and seed stage. And we're also industry agnostic. So in order to meet our kind of criteria for investment, you don't have to be headquartered in Pennsylvania. You can be set up as a Delaware C Corp, or I guess that's the most standard thing, but you have to have some kind of tangible connection to Pennsylvania in terms of key personnel or key operations. My role at the firm, my title is Director of Venture Operations. I'm basically the first non-partner hire into the firm. We've only been making investments since 2021. So we're about at the end of the capital deployment for our Fund 1 and looking forward to hopefully finishing up our fundraise for the Fund 2 and deploying new capital out of the new fund in early 2025. So yeah, happy to say more about that later, but that's us, whiteroseventures.com.
And for the next speaker, we have Scott Christensen. Scott, do you want to give a brief background of yourself?
Yeah, absolutely. So Scott Christensen, I work, I'm in Baltimore. I was a VFA fellow in 2022. I work at the University of Maryland in the engineering school on kind of two roles. One of which is I support a tech startup incubator called MTech Ventures, supporting deep, technology companies coming out of the research done at UMD. And then I also, and very relevant to this conversation, is for whatever reason, the Maryland Department of Natural Resources state agency uses our department to administer a seed capital fund, the Chesapeake Bay Seed Capital Fund, which has historically been a venture capital fund. But we're kind of shifting to how do we, fund social enterprises and, businesses doing a lot of this environmental work. So I came to this after I worked at an investment bank out in Western North Carolina called Carolina Financial Group. So that's kind of how I come into this work. I find it very interesting. Like, how do you match capital, the right type of capital to the right type of business? It's very interesting. So that's me.
Thank you so much, Scott. And finally, Brian.
Hi, everybody. I'm Brian Scott. I'm the CEO at Pitmoss, where we make soil and soil amendments out of all recycled material like paper and cardboard. We've been featured on Shark Tank. We were just named one of the most fundable companies in America by Pepperdine. And we've raised about $5 million in various seed rounds, done a bunch of non-dilutive funding, and we have experience with convertible notes, with safes, all sort of other things. I'll try to give a little bit of an overview of our capital stack and how we've been able to accomplish that.
Thanks so much, Brian. And I'm sure everyone's really excited to hear more. So Dustin, I'll give the floor to you.
Great. Let me make sure I can screen share. I think I had to request to do that. Let me know. Did you get the request for the screen share, or I have some slides, so I was planning to run through.
Right. Let me just make you co-host.
Oh yeah, that should do it.
Yeah, I don't think I have the ability to do that, Dustin. Just give me 1 second.
Oh. Aha, it's working now. Okay.
Oh, perfect.
So
Great.
let's see. It should work. Share. Oh yeah. Let's see. Okay, can everybody see this now, the slide deck? Okay, perfect. So I'm going to give an abbreviated version of a talk that I've given before that's longer, so just cut me off if I go for too long. So as I mentioned, we're White Rose Ventures, and I'm just going to share a little bit to kick things off about VC specifically. So yeah, this is some of the basics for those who might not, have probably heard about venture capital in the tech media, but might not know a lot about it. So, venture capital funds make minority investments, right? Typically in the range of 10 to 20%, can certainly be higher and lower than that, in equity ownership of their portfolio companies. And because they make minority investments of this size of percent of ownership, will often co-invest alongside other VC firms. Some deals are extremely competitive. Some deals, our firm is relatively smaller and newer, so there's typically room to invest alongside others. But so it's often a team sport. It can be like that. The equity ownership, most often, again, not always, exceptions to every rule, it will take the form of preferred shares, which grant VC investors and others in the share class additional economics and control terms versus common shareholders, which is typically, what co-founders and early employees would have if granted shares directly or options. And then also, I guess the third point is if able, and especially when a VC firm leads a particular deal, they'll often take board seats on those portfolio companies to help further guide and influence the executive management teams of the portfolio investments that they make. So we're going to talk all about the startup fundraising landscape here. This is just to kind of ground the conversation. Again, this is kind of an oversimplification. There's exceptions to every rule, but you can see there's basically, people who invest their own money, high net worths, your friends and family, family offices. Then there's people who invest other people's money. That's venture capital. And I'll say a little bit more about that. So, deal size somewhere in the range of, more than $100,000. The VC goes bigger, kind of the mega VC, but some 100,000 plus our initial check size at White Rose Ventures. We've done a little bit less than this, but it's typically in the range of $250,000 to $750,000. And then you have the kind of intermediaries, which you mostly want to avoid, but I'm just going to skip through this for sake of brevity. So here's a little more nuance. I think this is probably the most important slide that I'll share here, which is in terms of venture capital fund timelines and how they work. So I mentioned before, venture capital, we're really investing other people's money. The investors in the VC funds themselves are called limited partners, and they must be accredited, which if you're an individual, it basically means like you're wealthy. Could say more about that too, but there's also institutional investors in many venture capital funds, including ours. The other kind of key thing to know about venture capital as an asset class, though, is that it's highly illiquid. Funds may have unrealized markups as the valuations increase in subsequent financing rounds of their portfolio companies. But the really important thing to understand for VCs and their LPs is that the only way to actually realize those gains is through what we call a liquidity event, which is typically a merger and acquisition or an IPO of some sort, an exit for the portfolio company. So markups are great. It looks good on paper, but the only way that the VCs and the LPs really make money on their investments is through an exit, like a liquidity event. Venture capital investors, this is the kind of number one thing to sort of understand, is that they're sort of a slave to their fund timeline, which is typically a 10-year timeline, often with the option to extend for a few years afterwards. But the bottom kind of chart is really the most important thing, I think, for founders to understand about venture and how it works, which is where our firm is right now. I kind of mentioned in the introduction, we're in the fundraising period. So we're getting close to the end. We're hoping to get to a first close in our fund too here in the next couple months and be ready to start deploying capital out of the new fund. Like I mentioned, sometime in the early new year, but we're in this fundraising mode where there's no dry powder, right? And so we're still happy to have conversations with you. We pride ourselves in being very approachable and accessible relative to other VC firms. But the best time to talk to the investors is right after they close a new fund, right? And so that's typically in the first 1 to 2 years, is especially when they're really trying to get at least some of that capital out the door and invested into new portfolio companies. And then the next kind of 2 years after that. Once you get closer to the halfway point of the fund, of its life cycle, that's really where the remaining money, this is true for our own Fund 1, is reserved for follow-on financings. And you're really kind of just managing the existing portfolio of companies, the basket that you've already put together. And then as it gets closer to the end, this is where your relationship with the venture capital investor could start to become a little rockier. They might push you, and they might have, through the preferred shares that they hold, some ability through board seats to kind of push you maybe possibly towards a decision that maybe isn't what your first decision would be, which is to sell the company, to have some kind of exit or liquidity event so that the venture investor is able to return some money to the shareholders in their fund. So this timeline, really important to understand. Venture, it's venture capitalists manage other people's money, and this kind of 10-year timeline is roughly the way that they go. So to use a quick example here, again, cut me off if I'm going over time, but everybody sort of knows the story of Amazon, at least to some extent. They followed a trajectory somewhat like this. The numbers are a little bit different back in the 90s, but basically the same, right? So at the idea stage, Jeff Bezos famously founded Amazon in his garage. Friends and family sort of at the MVP stage. His parents put in almost $250,000 in 1994. Then shortly thereafter, there was one angel investor. And then they went straight away to sort of what I would say more Series A type funding. So they raised $8 million from the very storied VC firm Kleiner Perkins in 95. And then, relatively quickly, within 2-ish years after that, went public. So that timeline is a little bit different now, but roughly speaking, self-funding, friends and family, then angels, then venture capital. That's kind of the way the normal sort of startup trajectory goes. And yeah, somebody else mentioned briefly a little bit about this, but to say a little bit about the investment vehicles at the earliest stages, it's often not done through a direct equity financing. You'll use a convertible instrument of some sort, which is like a convertible promissory note, which is a debt that's intended to convert to equity at some point, or a SAFE note, which stands for a simple agreement for future equity. Either of those are very common, at the pre-seed and seed stage. And then once you go on beyond the seed stage, it's almost always an equity financing, right, where the company is actually issuing new stock and therefore diluting all the existing stock owners a little bit with each subsequent financing. This is really the last slide. I guess I wanted to make sure that I got to. I've got more in here, but like I said, this talk was usually quite a bit longer. This is kind of the thing to understand about the psychology, I think, of the venture capital investor, which is why investors only want to swing at a home run, or what a pitch that they think is a home run, to use a baseball analogy, which is, this venture investing, angels and VCs, it's very risky. And so founders have to give up something in order to make up for that. And this chart at the bottom, it's also data that's relatively older, from 2004 to 2013 from Correlation Ventures, but this still holds up today. And in VC, this is what they kind of refer to as power law, which is to say that almost two thirds of the deals that most venture capitalists make will fail. That means, like, they go to zero, they return nothing. The venture capital investor, every time they're making the investment, even in those two thirds, they're doing it hoping that you're going to be here on the outliers. But most of them fail. So you can say, venture investors are kind of silly, kind of wishful thinking. This is the way the asset class pans out. So after that, you've got kind of the next 30 some percent will roughly return the fund. And then it's really all the profits, all the returns that come back to the venture capitalists and the limited partner investors in the fund are from these investments that really 10x or more versus the amount of money that they put in. And that's less than 5% of the deals. So 1 in 20 investments that your average VC makes is really where they make all of their money for themselves and for their LPs. And so that's the psychology. And it matters, I guess, here is like, so why does it matter to a founder? Well, it's because you have to be able to effectively pitch your startup as being that type of home run investment opportunity, i.e. you have to sell it as something that can deliver venture scale returns, or could conceivably return not just the money that the investor is putting into you, but return their entire fund, right? And so that's kind of the psychology that you as the founder want to get into your own head in terms of how the investor is thinking, because this is the sort of thinking that goes along with the investments that they make. So this is a little bit about it. I could share more slides here, sort of about the investor decision making. I think, like, oversimplification again, there's sort of people risks, product risks, and market risks. Your friends and family, they don't perceive the people risk, right? They know you, they already trust you. So as long as they can see that there's some kind of MVP, some kind of products there, they're usually willing to, not worry about the market risk. That's a little outside of the friends and family purview. But then for your angels and VCs, they don't know you, the founder. And so they really want to see some amount of product and a believable market opportunity that they think, you can grow to be a venture scale company. And so the exception that a lot of founders will see is they'll say, well, this, idea stage valuation, this idea stage company my competitor has, they got a $10 million valuation at their pre-seed. And when that happens, it's almost always because that venture capitalist already knows that founder personally. So they're more like the friends and family in the sense that they don't perceive the people risk as much. Possibly this is the founder who's already exited or something like that. Again, that's not most founders. And so generally speaking, in order to be a fit for venture, you got to have some, I'd say more than an MVP, like a beta, a product that's, again, there's exceptions to every rule, but something that's in the market, something that a customer is really deriving value from already. And so that's a little bit about the different kinds of risks. All right, I'm going to stop there for sake of time, but glad to get more into it in the Q&A.
Thanks, Dustin. We have time for one question. Does anyone have any questions?
I'll ask a question. Do you see a big difference in the startups that you're evaluating in Pittsburgh versus other cities? And can you give us kind of the top line headline of what those differences are? Is it true, and maybe it's related, is it true that there's not as much money coming in here? Are you seeing what you're looking for? And if not, why not?
Yeah, it's a little harder for me to answer that specifically because in our fund one, we have only really invested in South Central Pennsylvania, but out of our fund two, we definitely are looking to go more statewide. We were in Pittsburgh a little over a month ago at the Three Rivers Venture Fair, and I was super impressed by the quality of the companies that we saw there. Many are university spinouts from intellectual property developed at UPitt and CMU and Duquesne. And so I was really impressed. I think that there's a lot of good things that Pittsburgh has going on for it in terms of being a kind of hub for AI, especially, as well as the life sciences on the East Coast. Not to say that there aren't other life sciences hubs on the East Coast. I think Boston, which somebody mentioned, is definitely sort of the biggest one, and there's a lot there in Philly. So I think like something that stand out for Pittsburgh is definitely the robotics and kind of AI. I feel like they are possibly the East Coast hub for that, and that really the only place that you would see more happening there would be in Silicon Valley. The investment thesis of our firm is definitely that there are a lot of opportunities here in Pennsylvania that are possibly more overlooked. Yeah, I think that there's a lot of advantages to building, here in Pennsylvania, just in terms of cost. I'm somebody who has lived in the Bay Area for a number of years before. I'm from Pennsylvania originally, and so I was kind of happy to move back to the area. But yeah, I think now, especially in the post-COVID remote building world, moving to fully remote teams or teams that have remote members, like you don't need to be in the Bay Area to build a startup, is what I'm trying to say. And I think there's a lot of advantages to being in Pittsburgh as well as elsewhere in Pennsylvania. So I'm not sure how well that answers your question, but I think there's a lot of opportunities in Pittsburgh, and I am super confident that in our fund too, we will make investments there.
Wonderful. Thank you. Very helpful.
Thank you, Dustin. And Scott, are you ready to present?
Yes. And how much time are we allocating? Like
10 minutes. Yes.
Okay. Just to make sure I'm not. Okay. Sounds good. I'm going to share my screen. All right, can you see my deck?
Yes.
And then if I play from start. Yeah, so I'm going to talk broadly about, funding for businesses that isn't venture capital. Just because I think a lot of, from my experience coming into this industry, oftentimes the focus is venture capital. But I think a very small amount of businesses are scalable in that way. So where it makes sense to have venture capital returns, it's tough, right? So just quickly, I'm going to go through my fund. It's a unique situation in which, we're funded by the Maryland Department of Natural Resources. We get $450K a year. It's been operating since 2008 as a venture capital fund focused specifically on Maryland businesses that are working at the intersection of nutrient pollution, climate change adaptation, and climate change mitigation. And throwing in that venture capital lens of only financing uber scalable businesses has really limited us. And it's also a function of only being able to fund the other two filters, Maryland and climate businesses. But the result is since 2008, we've had one exit. It was a 1.5x. It's just kind of a model that wasn't really working for us. And so I've spent a lot of time kind of thinking about what are the alternatives. And it's something I'm still in the midst of. So one thing I'm going to note is that I'm very Maryland specific, and I know a lot of people here aren't necessarily in Maryland. A lot of this is in Pittsburgh, but I would think a lot of the same trends hold. And so what I've kind of realized, right, is, especially when you're thinking about from a social impact perspective, ownership and who owns the business really kind of, ultimately governs the outcomes of the business, right? And so, as we were talking about, as Dustin mentioned, right, most of the time, venture capital, you're looking for an exit, right? Investors looking for an exit in 5 to 7 years. And this genuinely, in most cases, means, well, in a lot of cases, the companies ultimately fail, right? But in, good cases, right, you get an acquisition, and even better cases, you get an IPO, and they're pretty rare. From a local perspective, oftentimes this is not ideal, because if you think about acquisition, that is jobs and tax revenue that is going out of state. And generally also in that model, you see, and this is when people talk about bottom line, triple bottom line, you have the different, what are the objectives of the business? I think one issue that often comes up in venture capital backed startups is you do often have a hyper focus on the financial metrics, which can impact, the social impact or the other, objectives of the business. And so then it's, what else can we do, right? Because that's kind of like the predominant way of funding businesses. What are the other options? And so there are other options. I would just say it's a little bit more difficult to find it. There's generally not a one size fits all, as there more or less is in venture capital. So I think, this type of funding for a business just requires, at the beginning of your business being very intentional, doing a lot of research on who are the funders in your city, your county, your state, your region, who are the people that you can fund your business. And also just, you've got, and this happens in venture capital, right? Too, you just have to have a very robust financial model. That's something that like I have trouble with the businesses I fund, is like this is just a bit, this is not inherent to this funding model, but it's, you got to have a robust financial model. So options, there's a ton of options. I would recommend looking, there's a link at the bottom, and I can follow up in an email with these links because I'm gonna have a couple other links as well. But there's a resource called the Innovative Finance Playbook that does a deep dive into each of these different, financing models, and, offers a lot of resources around, what is the right type of business for each of these things. But the one that I guess two I would highlight is grants. A lot of businesses that I work with at UMD will get their initial funding from these are tech-based businesses that do a lot of R&D. And so they get an SBIR grant from the federal government. They get an STTR grant. Like there's a lot of federal grants available for tech startups. And then when you have a social impact, like if there's a specific social function you're trying to fulfill, there's lots of grants that are available, and it's hard to, elucidate on. There's not a one size fits all. So you almost have to hyper focus on the region you're in and find those resources. And so I think one other thing I'd mention is just that when you're going into these models, it's, most of these funders, they often offer extensive technical assistance and business support, with the goal being they want your business to succeed. And so like for the businesses I'm working on funding 2 businesses right now through these models. And it's just a lot of hands-on work to get them to a point where I think we could fund them. So I'm specifically focused on profit sharing models. And what I mean by that is, like, in our specific context, we have 500K each year. For the past 12 years, the DNR has gotten 0 returns. So they're not really interested in making, 10x returns. They're just happy to get money back. And so what I've kind of come to is this idea of profit sharing, which is basically, there's the terms that are, it's a little bit dense right there. But the point is, we will give a company, say 300K, we'll work with them to create a robust financial model, and they'll pay us back when they have profits, right? And so, and when they, that could be in 3 years. And so, they'll pay us back, we may put, a 5% interest rate on a profit share, 300K. And when you generate, profit, you start paying us back until that, 300K, 5% is paid off. And I'm pulling this from a group called Seed Commons. I checked, they do not have a location in Pittsburgh, but they do have one in Philly that oftentimes they work, if they don't have a location in Pittsburgh, you can likely work with a Philly one. I'm not specifically certain. But the way this model works is just through having a robust relationship with the funder and really leaning on them for technical assistance, bringing them on as a partner in your business. And that's kind of exactly what this goes for. When I'm not tied to a specific instrument, I kind of focusing on the profit share model because I'm funding businesses alongside Seed Commons. We're co-lending. But my we have a broad mandate. We can fund with many different instruments. And so when it comes to profit sharing, though, what I'm specifically looking for is that the businesses are largely funded through the tech-based businesses, at least, are largely funded with non-dilutive capital, and they have kind of a minimal, no more than like $1 million or $2 million that they need for commercialization funding. I don't want to just read the slide, but a realistic path to profitability within 3 years. I'm obviously looking for, environmental impact. And then I think it's a tougher fit for businesses that there's not, the pros of venture capital obviously is there's a ton of money available to do, a venture capital deal. And so for businesses that are, I looked at a geothermal company, right? That is not going to be you're not going to get social enterprise funding for a geothermal tech play. Like that's, I mean, you might, but that's not even necessarily true. Like you can get grants. But my point is, these funding models are often a better fit for the Main Street, if you've heard that moniker, Main Street type businesses. And it's very difficult for, businesses that require, breakneck pace growth. Think about food deliveries. Like you're not going to get social enterprise funding for an Uber Eats competitor because that company is just going to get walloped by the venture capital backed competitors. So these are just some of the funders in the space. I do a lot of work with each company to identify who's the possible funders for each company. I have a resource document that I work through with companies, and I lean on the funding library linked here. And again, I'll send these links. And so that's essentially it. I have the quick definition of social entrepreneurship. There's lots of different ways you can structure your company, whether it's benefit corporations, cooperatives, worker cooperatives. Oftentimes you see nonprofits that are building revenue streams. I'm specifically, focused on worker cooperatives in a lot of the businesses I fund, which are just democratic businesses. And so that's, there's a lot of actually a kind of a ridiculous amount of funding available for businesses forming as worker cooperatives. And then I was just kind of putting this together at the last minute. I think for a Pittsburgh perspective, I'm not necessarily sure who's working in this space. I do know there for worker cooperatives specifically, there's the United States Federation of Worker Cooperatives, it's USFWC, that they do a lot of technical assistance for businesses forming, and they can, oftentimes can plug in and bring resources to that said business. So yeah, that's my presentation. Any questions?
Yeah, thank you so much, Scott. I really appreciate your perspective, and I really love bringing you into this panel because I think you offer really alternative sources for funding and also emphasizing opportunities for social impact startups and other opportunities for social enterprises. So this is great. Does anyone have any questions? I know I see a couple from the chat. Justin, did you want to ask your question?
This one might not be relevant to Scott. It's more for the other members, just based off of his focus. But I'm just curious, what's the attitude right now towards revenue, user counts, profitability for AI agent or vertical agents in general? Is it dependent upon your main customer or, your market? What are the things they look for there?
Any of the speakers would like to take a stab at it?
I think that was directed at me, but I really don't have a good answer. So we're industry agnostic. Yeah, none of our 13 portfolio companies fit anything like an agentic AI. So I know this is a very hot thing right now, but yeah, I just don't have enough experience personally to really point towards specific metrics. I think I have a general link that I sometimes send founders with benchmarks, a lot of questioning like, well, and when is the right time to raise funding? And what benchmarks do I really have that are kind of industry agnostic, sort of very high level? But the best way to really do it is to look at comparable deals, right? And a lot of times it's not fully disclosed. A lot of times the companies will announce, hey, we closed this seed round of this much money, including like these specific investors. But even in that case, it's very hard for you often to look under the hood and see like what are the real kind of KPI metrics that they're tracking and benchmarking for their own success. But that's what I would encourage you to do, is to just like look for much more comparable deals. I just don't have a good answer to give you a real definitive quantitative answer.
Yeah, and I can add to that because we're doing this a lot, Justin. Honestly, in the space, we're building AI for a number of our customers on an innovation side, and it really is use case dependent, as kind of Dustin's alluding to, and it's industry specific, use case dependent. What's it going to do in that space? And the investment is wild at this point. The market's still trying to figure itself out how this actually works appropriately.
So in other words, get in right now. Is that what you're saying?
Find something that you do well in a niche and use that.
Perfect.
Awesome. Just to keep this session interactive, I had prepared a short intermission. I'm going to share my screen, and you would have to take out your phones to scan a QR code.
Are you hacking us right now?
All right. Oh, don't look at the... All right. Can everyone see my screen?
Yep.
Awesome. So I think if you click the... Okay, we have 3 people, 4 people. We got 7. I know there's more. Unless everyone's asleep, but I'm hoping not. Okay. All right. So going to the next slide. The first question is, so Rockefeller, the first billionaire in the US, invested an initial blank to his first company. Since we're talking about investments and capital and resources, how much did Rockefeller invest in his first company? So this is from $1,000 to $100,000. All right, I'm kind of seeing initial 1,000, more in the lower end. So no one thinks he invested more than 100,000. Okay. So the answer is 4,000. Wow, we got about 6 people got it right. Awesome. Next question. MailChimp, a successful 2 billion email marketing company, was bootstrapped for how many years? From 1 to 15. How many years was MailChimp bootstrapped for?
I was actually just
Okay.
looking at this. I forget the answer though.
I'm seeing, okay, we're seeing a lot in the 7 range. The answer is 8. 8 years they bootstrap for. So if you're in your first year or second year of bootstrapping, don't lose hope. You might become a 2 billion email marketing company. And lastly, what resources or topics would you like to see for our next event? Just a quick 2 to 3 words. Okay.
Sorry,
In
Julie,
person.
is this for the VFA Skillshare specifically
Yeah,
or
so
Tech
just,
Council? Got it.
yeah, so Skillshare, yeah, Skillshare, Tech Council, and kind of just resources that we can offer. So have this topic, but in person. Have 12 responses. Bringing in investment to Pittsburgh, business plan creation workshop, roundtable of Pittsburgh startups, how to manage short runway situations, 0 to 1, cybersecurity, fundraising for Pittsburgh, recent startups that got funded to talk about their experience, which Brian can probably speak more about, go-to-market strategies, B2B, how to apply for accelerators, building a consumer goods company. This is, yeah, these are all wide range of topics. So we're really excited. So we're hoping that would be able to kind of provide more resources in the future in the next year. So we'll make sure to have that. And yeah, that's all for intermission. Thank you for participating. And now we have Brian Scott to continue the presentation.
Hi, everybody. Can you see my slides okay?
Yes. Yeah.
Yes.
Okay. So again, I'm Brian Scott. I'm the CEO at Pitmoss. We've been pretty successful at raising more seed level, not necessarily Series A yet. And I was asked to talk more about angel investing and startup fundraising. So that's a little bit more of my focus. I'll also mention I've been an angel investor since 2009. I've made over 40 investments myself. And I also helped Blue Tree Allied Angels screen more than 5,000 companies in that time. So I've looked at a lot of potential deals. The other thing I'll mention is this is a very wordy deck, but it's intended to be distributed to you guys so that you've got the notes and you can read it. Um, and I'm very open to like hearing from people. It's super simple, brian@pitmoss.com, if anybody has any questions or would like to do some follow-up. So the first thing I wanted to mention is when you think about fundraising, especially as an early stage startup, think more about your capital stack and not necessarily just equity fundraising. So somebody mentioned earlier about grants. We've received a bunch of them. We've applied for a bunch of them. Think about as much non-dilutive funding as you can do early on. A lot of people mentioned equity investments from friend and family, seed round, Series A. I won't go through a lot of that, but we've been pretty successful with raising with angel groups. Um, we've also done 3 different crowdfunding platforms, so I could answer or help people out if they've got questions on various platforms, what works, what doesn't, that sort of thing. We've done convertible debt, we've done traditional debt, and we've used various instruments like safes, convertible notes, or equity. And then there are other debt options out there, depending on what your cap table looks like, related to the SBA, personal guarantees might be required, that sort of thing. So just think about in general your capital stack, not just your equity fundraising. Um, some tips related to equity fundraising: just understand before you go in, the deck is stacked against you. As I mentioned, I've screened over 5,000 companies. Maybe Blue Tree had invested in 70 of them over that time. So it's a very small percentage that gets funded, and it gets even harder at the VC level, at the Series A level. Some people have mentioned this stuff. I'm going to skip through a few things, but be ready to cede some control. If you're going to do equity fundraising, you need to understand you're going to have a board of directors, a bunch of other things you're going to need to manage. The other thing I would mention, it's kind of a term I made up, but fund strapping or boot raising. And almost all the time I've been at Pitmoss, we're always in some level of fundraising and some level of bootstrapping, because we never get a big chunk of money all at once. It's always been a little bit of a trickle where you need to manage cash like very closely throughout the time. Plan properly, make sure you're making a good ask, and keep in mind that it'll be 2 times probably the time and the money that you're expecting when you put your plan together. Understand you're probably going to need a local lead and a due diligence report, and then you're going to need syndication partners. So the other thing I tell people before you even start to think about fundraising, you need to do a bunch of prep work. And that would be really nailing down your elevator pitch first, having a really good 1-pager or executive summary, and understand that you're going to use and reuse that text a bunch of ways for grant applications, for platforms like Gust or Proseeder. So spend a lot of time writing a good executive summary that's reusable, and manage your word counts as well. You need a really good financial pro forma. You need to understand it really well, and you need to almost have it memorized. I'm not going to spend a lot of time on the pitch deck. Guy Kawasaki is really the standard. The one thing I will say is, after you put together your pitch deck, be really careful about what you do with coaching. People will talk about entrepreneurs being coachable, but the flip side of that is, if you talk to 10 coaches, they're going to give you 10 different ideas on what needs to be in your pitch deck. So just be careful about what you do with coaching. Customize your deck. I always have extra slides depending on my audience. Some angel groups will ask you to follow a specific format. If they do, do that exactly because they're generally grading you on the format that they want to see. Um, Practice, practice, practice. Do time rehearsals to do your pitch in 3 minutes, 5 minutes, 10 minutes, and be able to present your deck on whatever time frame people give you. Um, I'm going to skip through a few other things here, but make sure you have a good deal room because if you get to due diligence, you'll either be stuck in due diligence for a long time, or if you do your prep work and have a good deal room prepped, it can help due diligence go much faster. Again, think about a local lead. If there's one thing I want people to take away from this presentation today, it's build your network, find your advocates. In order to get in an angel group or a VC fund, you really, really, really need a warm introduction. I can't stress that enough. If you cold call on an angel group or a VC fund, there's a 99% chance you'll get no answer at all or a turn down. So you really need to try to find a warm introduction. If you invest in anything, invest in your pitch deck so it looks really good and professional, a background like you see behind me now, so that when you're pitching to people and you have a good background, they understand that you have put time and money into a professional presentation. So doing your graphics, if you need to pay someone to help with your pro forma, do that as well. Those are all things you really need to be prepared for. So when it comes to who to pitch, I saw some questions already. The Angel Capital Association lists pretty much every angel group in America. It's an easy way to go out and look for good matches for angel funding. PitchBook is another resource. It's a very expensive thing to access, but people like the Tech Council, Innovation Works, some VCs that are friendly to you will help you with PitchBook, doing a search on who you could approach. Gust and Proceed are other platforms. I'm not going to spend a lot of time on that, but just understand there are resources for you to try to find good matches. Do due diligence on your potential funders. I'm not going to go through this list, but it's a takeaway for you. The most important thing is don't waste your time. Don't waste your own time as an entrepreneur. It's very valuable. Make sure you've got good matches. Make sure that people are clear in who they fund, how they fund, what the timeline is, what the check size is, what sort of success they have. I refer to the term a lot, inside baseball. Find your advocate, get an introduction to the group or the VC, and use them for truthful feedback beyond what the official feedback is that you get from the angel group or the VC fund. LinkedIn's a great way to connect the people that way. And lastly, just quickly, pay for play. Do you do it or not do it? I'd be very, very careful about it. I'll share experiences offline on who I've been willing to invest in and who I'm not willing to invest in. Just understand that there are some people that prey upon entrepreneurs, and there are some groups that are out there that are more interested in generating fees from getting people to pitch than they are funding people. So be very, very careful about that. I mentioned about the inside baseball. When you're ready to pitch, use your advocate to customize and practice your pitch. Build the custom deck we mentioned. Do some Q&A prep with your own team, with other investors. Make sure your answers are short and sweet and practiced and rehearsed. Make sure you know your numbers. Make sure you know your weaknesses, because people will find your weaknesses and they are going to harp on that. Have really good answers for the biggest weaknesses that you know that your company has got, and have them rehearsed and practiced. Keep in mind, your goal when you're pitching is to get a deeper dive. You're really only out there trying to get enough information to pique somebody's interest. You're not there to explain your entire company. Be 100% positive, show no weakness. When people are screening you, they're looking for reasons to not fund you, not necessarily reasons to fund you. So be very careful about what you do and how you answer questions. people don't listen when you pitch. If there are certain really key important things in your deck, make sure you hit them over the head with it. So just keep that in mind. Don't be discouraged when people are not necessarily paying attention or missing a big point. It's up to you to make sure that you're hitting those points and know and answer your questions before you get them. So once you've practiced enough, once you've pitched enough people, you're going to see recurring questions. Make sure that you work those recurring questions in your deck so that you don't get them, and then you do get valuable questions. Post pitch, check in with your advocate for feedback and any corrections you need to make. Revise your pitch and your deck as you go. Again, the due diligence process, make sure you've got your deal room ready to go. When you do have a due diligence call or written responses, include your advocate. Like a lot of times they can help you in how to work with their group. Next basically means when you get a turn down, just move on. Don't waste time trying to convince somebody that gives you a no, even if their explanation for not funding you doesn't make sense. Just move on, but make and keep good notes, especially about the milestones that they're expecting from you, because at some point you may want to circle back to them when you meet certain milestones. Take away those excuses they gave you for not funding you earlier. If you have success, you're going to get to a term sheet, negotiation, and syndication. Post-investment, in my mind, this is super critical. Make sure you keep and publish your due diligence report because future funders will want to see prior due diligence. Give frequent updates to your investors. So whether it's an investor or friend groups that have turned you down, you want to keep them in tune with your business because you may come back to them in the future. Put your investors to work. Make sure they're helping you develop your company with either intros for funding or your business. Look for advisors out of your investor base. Develop what I would call an IRM, an investment manage or relationship management software. For me, it's an Excel spreadsheet with a bunch of tabs with anyone I've ever talked about with funding, whether they're a friend to give me a referral or whether they're somebody that turned me down or my current investors. Again, consider your overall capital stack, even post-investment, and always plan that you're going to have a next raise. My general tips are just always be networking, always be building your list of people you can reach out to. Keep all of those basic narratives to update and reuse for things like Gust, for a grant application, for an accelerator application. You'll save yourself a lot of time from needing to like rewrite a bunch of portions of your executive summary. Do a great job of communicating your updates. Use every single tool in your toolkit to build a history over time. So use positive PR, customer traction, revenue traction, building general excitement, using anecdotes of customers that love your product. You're really building a story around your company that you're going to use long-term for every level of funding that you're going after. We'd like to apply for almost anything within reason, whether that be a contest, an accelerator, a grant. Even if you don't get money, it typically turns into good PR and good networking for you. Be coachable, but as I mentioned, also go with your gut. If you think something will work, try it. Go for it. Understand that nobody knows your business better than you do. So even though people may coach you, they may have a high level understanding of your business. You have a way deeper understanding of your business. Don't be afraid to circle back over time. If you get a no from somebody or a turn down, 2 years later, 3 years later, you may meet all their criteria. They may be more familiar with you and much more apt to fund you. Lastly, I'm going to give you guys a group called Pitch Force that we have pitched with before. You can find them on YouTube. I'm going to give you a link to one of our pitches on Pitch Force here. And it's a really, really great way to, you're going to see 5 or 6 companies give like a 5-minute pitch. They're going to get feedback from judges on their pitch, and then they get graded. We happen to win this twice with Pitch Force, once on the seed round, once on the Series A round. So you can see our pitch on there. But it's really, really valuable if you've not done a lot of pitching to see what people do for their pitch deck, what graphics they use, what kind of questions they get, how they answer questions. And there's tons of videos on their YouTube channel. So you can spend a lot of time out there looking if you want. So that's it for me, and I'd be happy to answer any questions or take emails if people are looking for more information.
Thank you so much, Brian. That was a lot of wisdom and knowledge that you had shared. And honestly, that's exactly what I had hoped that you would share for entrepreneurs, words of encouragement and valuable direction and guidance. So thank you. Does anyone have any questions? We can probably take 1 to 2 questions for all of our speakers.
Hey, I had a couple of questions. The first one is just for Dustin. For the you're trying to the outlier slide that you shared. Would you say it's more important to try to convince VCs that you will be an outlier, or that if you're an outlier, you'll be a major outlier who's gonna bring the big return?
It's just the growth story that you tell. Like, you have to project in your pro forma, whether it's a 3 or 5 year kind of financial model. Like, you want to project a optimistic but believable growth scenario in the story that you're telling, where you could potentially be that 10x, like be a true venture scale return. If you pitch an investor and say, like, a VC investor, and say, in 6 years, I'm going to 3x your money. That's like what Brian was just saying about kind of looking for reasons to say no. That's a no, right? So if you have a kind of more conservative, kind of middle of the road, and maybe more aggressive model, tend towards using the aggressive model with the VCs specifically. Again, I answered a question in the chat that was sort of about, do all VCs work this way? No. I mean, angel investors are investing their own money, so they're not beholden to the 10-year timeline. Therefore, they have the ability to kind of be more patient. And so maybe the middle of the road kind of financial model is the one that you would defer to in a situation like that. But with some exceptions to every rule, I do think that the story that you're telling needs to be about high growth if you're targeting VC. So yeah, I hope that answers the question.
Definitely. Thanks.
Thank you, Rory. And I think we are over time. So thank you all so much for joining today. Really appreciate your time, Scott, Dustin, Brian. Truly, really appreciate sharing your knowledge to everyone on the call. And I will send a follow-up email with all of the information and resources that were shared in this call. But thank you all. Have a great rest of your day.
Thank you, everyone.
Thanks, everybody. Bye.
Thank you, Julie. Bye-bye.